understanding of deferred taxation. When somebody says the words deferred taxation, then what comes to your mind? Because this is one of those areas that normally kills students here. And yet it is very easy. It is very easy. Deferred taxation in your own language. In your own language, I would want to hear from you. Whenever they mention the word deferred taxation, what comes to your mind? As I wait for you great students of mine to speak to us, I can take this 1 minute here to simply try to explain to you in my own understanding. The word deferred means delayed. I can't hear you. Are you guys able to hear Mwalimu? Yes? Yeah. Resa, maybe it is your network. If somebody can just tell Resa to get out and then he comes back, it'll be very good. Because I can see mine is very... So taxes not paid in the current year, but will be paid later. That's what I wanted to explain actually. Yeah, that you're not going to run away from paying this tax. All right. In the long run, you'll be paying this tax. But at least you have some waivers on this tax in the current year. So it's very, very important, ladies and gentlemen, whenever we talk about taxes, to always think about whatever we are doing, what is the implications of our activities in the future as pertains what year? Taxes, as pertains taxes. So now we are looking at this question called August 2022. I'm telling you, ladies and gentlemen, I've been in this industry for so long, and I know there are areas that we should never joke about. If you remember, I'm known in this market for what we call low-hanging fruits, where I simply take students here, in this case here, through some like 8 sessions, and then I assist them to know how do they get to harvest quick marks in their exams. And I can tell you from the word go that if there are areas that you can easily harvest, your marks in this case here, easy marks in this case here, will be from deferred taxation. Deferred taxation. And this is the question that I would want us to really be good at. So here I share the very first thing that I will be able to do on this LMS is to ensure that I increase my speed. At RCM, we don't watch, in this case here, these videos at a speed of 100. No. So how do I change my speed? I'll come to settings here. I hope you're able to see my screen. I'll come to settings here. So in the settings, you can see myself. I normally watch them at 2, but you guys don't try at 2. You guys will watch at 1.5. Because the semester is really, really reduced. We can't watch the videos at normal speed. Yeah. So in this case here, my students at RCM, they watch at 1.5, or at the very worst, they can watch at 1.25. So because we are watching this together, I can't do it at 1.5 because I know I'll get issues. So because you're watching this together, I'll do it at 1.25, like that. The question is August 2022, question number 2B. Question number 2B, then I'll maximize my screen, and then I'll start playing. Sorry, first, have you gotten the question itself? I'm reading the question. I don't know whether you guys have access to the question. Do you have the question itself, which is August 2022, question number 2? Please give me, in this case, some signal. Tell me why for yes. Otherwise, I've just started where I'm just reading the question directly. Do we have the question paper now? Is there somebody who has been able to share that question paper with us? Wait, today you guys are not talking to me very fast, and the way time is not on our side. You even came late to my class today. You're not talking to me. I would really wish to get you guys talking to me. August 2022, question number 2B. August 2022, question number 2B. I suppose that silence means we are okay. Now I can continue reading. We have T Limited owns property, plant, and equipment that costs 625 when So we are told here, T Limited, a public limited entity is a holding company in a group of companies. The following transactions relating to deferred tax were extracted for the purposes of finalizing the group financial statements for the year ended 30th April 2022. We have T Limited owns property, plant, and equipment that cost 625 when purchased. Depreciation of 250 million has been charged up to the reporting date of 30th April 2022. The entity has claimed a total capital allowance on property, plant, and equipment of 300 million. On 30th April 2022, the property, plant, and equipment was revalued to 575 million. So we have here our property. So this property, we are only interested in two things. What is its carrying amount? What is its carrying amount? And what is its tax base? And once you give me these two, then straight away, I'll be able to give you what we call the temporary difference. The temporary difference. Once you give me those two, I'll be able to give you the temporary difference like that. Now, ladies and gentlemen, please listen and listen to me very well. This property, what are they telling us? T Limited owns property, plant, and equipment that cost 625 million when purchased. Depreciation of 250 million has been charged up to the reporting date. So, ladies and gentlemen, then how do we get our net book value? You see, carrying amount is the same as net book value. Carrying amount is the same as net book value. It will be cost minus accumulated depreciation. All right. So like now the cost, this particular property cost us how much? The cost is 625. And to date, we've been able to subtract there. To date, we've been able to charge depreciation of 250. 250. So can somebody in this particular case give me this value? 625 minus 250 gives me what here? The net book value. Net book value will be this 625 minus 250, which will give me what value? Which will give me what value? So somebody is telling me that this should be 375. So this is what I should really bring here. However, later on we shall be seeing what is happening here. So property, plant, and equipment, we have a property whose carrying amount as at the moment before we look at the revaluations is 375. We leave it there. Now, ladies and gentlemen, after that, we continue reading. We are told here the entity has claimed a total capital allowance on this property of 300. So then how do we get tax base? The same. Tax base. Remember the tax accountant and this normal financial, this is a tax accountant, this is a normal accountant here. You guys, they use the same principles. However, when it comes here, now we shall use it. So tax base here will be equal to cost minus, in this case here, accumulated capital allowance minus accumulated capital allowance. So the taxman will allow what we call capital allowances, the wear and the tear. All right, this guy is charging depreciation here. So the cost will always be the same. The cost will always be the same. 625 minus capital allowance. Are you able to see the capital allowance? The capital allowance, ladies and gentlemen, you're given there. The capital allowance you're given there on capital allowance you're given there is 300. It's 300, not number one. Capital allowance given there is 300. So 625 minus 300, this gives me 300 what here? 325 tax base. 325. So I'm on the verge of straight away thinking about how do I get this temporary difference? But before I do that, there is now a problem. We are told on 30th April 2022, the property, plant, and equipment was revalued to shillings 575. So there's a revaluation. Normally in our books of accounts, what do? We have this particular vehicle. The vehicle here, the net book value is, for example, 370. Just giving an example of a vehicle. And then we come and get a valuer. So this valuer is able to say that, hey, this vehicle is supposed to be worth 400. So in our net book value, in our books, we shall cancel that net book value and write the revalued amount. The revalued amount always takes precedence. So straight away, once I know that there is a revalued amount for this property, there is a revalued amount of 575. I just need to come here by the side. I strike this off and I call this 575 as my new book value, So once I have this as my new book value, then the temporary difference will be 575 minus 325. So can somebody give me this temporary difference? Can somebody give me this temporary difference? Can somebody give me this temporary difference? 575 minus 325. So this one here, Mike is giving me a few. So remember the concept that I've used there is this IFRS 13 on fair valuation, which tells us that we as accountants, of course, we know that we maintain our books at net book value, where we take cost minus what accumulated depreciation. But after some time, it is important you bring in a valuer. So if, for example, we have a vehicle whose net book value is 50 million, and then we have a valuer, an expert in the industry, who comes and tells us that, you know what, this vehicle of yours is supposed to be worth 56 million. We shall always maintain our assets in our books at fair value. That's why you've seen me canceling that 375 and I'm putting 575, which is the new fair value. Fair value is also known as market value. So the new market value. So that is it. Please continue watching. Figure of 200 what here? 250. But at the back of our mind, we know that there is a working that will have to go to the deferred tax account. All right. There's an asset here that has been revalued, and this is an upward revaluation. So don't forget. Can you kindly give me this revaluation? A revaluation upward. It's a revaluation upward. Remember, this thing was valued at 370, was valued at 375 initially. Now it has been revalued to 575 to match. So 575 minus 375. So this gives us what revaluation. And this is you're writing it by the side. You're writing it by the side. So the revalued amount here is 200, and this will affect our deferred tax account. The devalued amount will always affect our deferred tax account. So you see how the devalued amount will always affect our deferred tax account. That's very good. Now, ladies and gentlemen, note number 2, if you allow me, note number 2. On 31st October 2021, the company completed a development project. And incurred a cost of 200 million, which it capitalized in accordance with International Accounting Standard number 38, intangible assets. So then, ladies and gentlemen, here we have what we are calling some intangible asset. Intangible asset. So intangible asset, what have they told us? Which it capitalized in accordance with International Accounting Standards number 38, intangible assets. So they took this as the capital, the cost. All right. The cost. The estimated economic useful life of the intangible asset was 5 years at 31st October 2021. The company obtains full tax relief for research and development expenditure on cash basis. So this will not defeat me at all. So the first thing that I need to do is to come here and appreciate that this intangible asset, the intangible asset cost here, the cost is 200. All right. And this cost, ladies and gentlemen, in this case here was incurred when? 31st October. It was incurred on 31st October 21. But you see, we are doing our accounts. If you read the requirement, we read the requirement. They want us to compute the relevant temporary differences as at the end of its financial year, which is 30th April 2022. So we're doing our accounts on 30th April 2022. All right. So from the time when we incurred this cost, there's time that has lapsed. So we must charge in this case here amortization to be able to get the net book value. Because amortization is the language of depreciation, but now for intangible assets, you call it amortization. So come here, and the less in this case here, accumulated amortization. Very easy. They've told us it's 200 straight line, and the economic life is 5. Economic life is 5. So in this case here, we have 200 divided by 5. We have 200 divided by what year? Divided by 5. 200 divided by 5. Great. But now remember that is per annum for a whole year. That's amortization for a whole year, and yet we've stayed in this case here for how many months here? Look at this. Don't count October. These are the end of October. Don't count October. So we have November, December. And then here we have 4 months because we're going to the end of April. So those are 6 months. So in this case here, the amortization for the 6 months, this will be times 6/12, which will end up giving me how much, ladies and gentlemen? Which will end up giving me how much, ladies and gentlemen, if you're able to remember? Which will end up giving us how much here? So this gives us 20. This gives us 20. So 200 minus 20 gives me 180. So this is what we call our carrying amount of this particular asset. So here we have intangible asset of 180. Intangible asset of 180. Intangible asset of 180. How about in this case here, the tax base? This is quite easy. Remember, in most cases, intangible asset, the government would always want to incentivize you to do research, to develop things. So the government would want to allow this in full as early as possible. When you calculate this, you claim the whole of it. Claim when you put tax on it like that, the whole of it. You claim the whole of it. So gentlemen, remember for the tax base, and I'm explaining this for now the very last time, the tax base should always be equal to cost, less in this case here what is allowed. The allowable capital allowance. Allowable, or rather minus just capital, minus capital allowance here. Capital allowance like that. So what have they told us regarding this intangible asset? They've told us the company obtains full tax relief for research and development on cash basis. So we incurred a cost of 200. And these guys, because when we incurred this, immediately at the point of incurring this cash basis, the whole of this amount was allowed. So meaning that now moving forward, because we have already claimed this, moving forward, the tax base for this particular asset will be 0. The tax base will be 0. So 180 minus 0 gives me a temporary difference of 180. Because to get temporary difference, don't forget, to get temporary difference, we normally take carrying amount minus the tax base. Anytime they want us to get the temporary difference, this temporary difference, we take carrying amount minus the tax base, All right, so that's number 2. Unless there is a question, you guys allow me to go to number 3. Number 3, during the year to 30th April 2022, T Limited transferred goods worth 1,500 to one of its subsidiaries. So intra-business, inside business. We should not be making profits from ourselves here. 1/3 of the good, T Limited made a gross profit margin of 20% on its sales. 1/3 of the goods remained unsold by the subsidiary at the reporting date. This is very easy. So we have an item called inventory. We have an item called inventory. Now remember, the tax base, in this case here for inventory, the tax base for inventory will always be equal to the remaining intra-sales. That's how I master it myself. The tax base of this inventory is all in between from group of, or rather a component in the group to another component. So the tax base of inventory will always be equal to the remaining intra-sales. Remaining intra-sales. So remember the total goods that we sold between ourselves here were 1,500. This is the total intra-sale. But by the end of the period, we had already been able to sell some bit of it. What I'm interested in is the amount that remained. And we are told, ladies and gentlemen, here, that 1/3 of the goods remained unsold. So 1/3. So times 1/3. So in this case, the remaining, I hope you've written this in full, the remaining intra-sales will be 500. Is that correct? Is this correct? The remaining intra-sales will be 500. Yes, somebody has confirmed that. So this one, I'm not going to do any alterations. So in this case, the tax base there will be 500. Inventory, whenever there is an intra-group thing, inventory, the tax base will always be equal to the remaining intra-sales. There's no debate about that. But now the accountant will always have a few issues. The accountant now appreciates the concept of what here, the accountant here, carrying amount. The accountant must consider, the accountant here, in this case here, consider UPS. UPS is unrealized profits on stock. So consider UPS. UPS is unrealized profit on stock. That's how you take a small note there. So for carrying amounts, always consider the UPS. And how do we calculate this UPS? To get UPS, we normally take profit margin times remaining intra-sales. So anytime, ladies and gentlemen, they want you to get UPS, unrealized profits on stock. UPS is unrealized profit on stock. You always take the profit margin times the remaining intra-sales. This examiner was gracious enough. He gave us profit margin there. If you look at note 3, he gave us a profit margin of 20%. Unfortunately, we have the remaining race here. We have the remaining intra-sales. The remaining intra-sales is 500. So what is 20% times 500? What is 20% times 500, guys? What is 20% times 500? So it is 100. So we know that this is fake value. Remember, according to IAS 2, there is no way you can ever have profit within stock. According to IAS 2, we should always have inventory valued at the lower of cost or net realizable value. Let us talk of cost. You value inventory at cost. How much does it cost you? Never have profit inside there. So remember, one of these companies in the group are sold to the other. So we have in this case here, this other company that bought, it has goods in stock, and those goods have some profit inside there. So we need to deduct. So whenever it comes to the carrying amount now for this inventory, carrying amount for the inventory, you take the risk given minus now the UPS, because UPS is fake value in stocks. So you take the remaining intra-sales. The remaining intra-sales is 500 minus UPS, which is 100. So 500 minus 100, ladies and gentlemen, that gives me inventory carrying amount of 400. And then 400 now carrying amount minus tax base. This gives me 100 bob, like that. This gives me 100 bob like that. So in inventory, we have a very, very important carrying amount in inventory. Remember, the taxman will not allow those things of telling him that you have moved goods from here to another company, that now you would want, in this case, some tax waivers. The taxman is aware of creative accounting. Everybody start telling that, you know what, this sale that we made this sale to one of the subsidiaries. And then you start running away from tax. So the taxman, him, is not interested with any profit, which is what here, any profit in this case here, which is unrealized. If you charge it, he'll tell you add back. Add back. He's not interested with that. All right. He's not interested with that at all. So taxman, his tax base will automatically be the remaining intra-sales. How much is remaining? 500. That's it. But the accountant down there, he has been given a whole standard, which talks about what here? Which talks about 100. Which talks about, in this case here, some UPS. I think there is a question. Sorry. I think there is a question here. Let's first of all address comments here. Please feel free always to ask questions. Feel free always to ask questions. What is negative here? Is it negative? Is it negative? What is negative? 400 is negative. Why negative? Mwikali. Jane is also saying 100. 500 minus 100. Yeah, I should repeat on inventory. Okay. But why are they saying negative? 400 minus 500. Yes. Thank you very much. 400 minus 500. Yes. The temporary difference. Yes. 400 minus 500. Yes. Thank you very much. This gives us minus 100. Thank you very much. This gives us minus 100. So allow Mwalimu then to repeat here. This is inventory. So we look at inventory, two things. We have inventory. So we look at this from the taxman first. The taxman, the tax base. How do we get the tax base? To get the tax base, ladies and gentlemen, we shall always look at the remaining intra-sales. So remaining intra-sales. Very easy. So here we sold goods worth how much between ourselves? 1,500. And by the end of the year, the fraction. Okay, great. So the fraction in this case here, the fraction that was remaining was a third. So the remaining intra-sales, which is our is 500. The remaining intra-sales is 500. This is what you transfer here. The taxman, he takes the remaining intra-sales. Remember, in inventory is what is left. Otherwise, the component of units we sold to the subsidiary, which we were able to sell, they book that as sales. We're only interested in what was left behind in inventory, not sold and sold. So it's a third. And then you come, in this case here, to inventory, we come to the carrying amount. How do we get this carrying amount? To get carrying amount, we shall take the remaining intra-sales minus what we call unrealized profit on what here? On stock. Unrealized profits on stock. Please write this in full. Unrealized profits on stock. This UPS is unrealized profit on stock. Unrealized profit on what here? On stock. And how do we calculate this UPS? It's very easy. You take the profit margin times remaining intra-sales. So profit margin has been provided this question. The profit margin, we are told there in note 3, that profit margin is 20%. The profit margin is 20%. So profit margin is 20% and remaining intra-sales is 500. So 20% of 500, this is how we were able to pick that 100 bob. And then our risk here is 500 minus, in this case here, 100. So 500 minus 100, that's how we were able to get 400, Mike, like that. That's how we were able to get that 400. I hope, Mike, now this makes some sense and you'll be able to follow it up. Okay. However, your examiner will always tempt you. Instead of him giving you profit margin, I've always seen this, he rarely gives profit margin. What he will do, this ninja, he will come here and tell you that profit markup is 20. Profit markup is 20%. So when they tell you that the profit markup is 20%, and I know that to get UPS, I need profit margin, what shall I do if my profit markup is 20%? If my profit markup is 20%. Profit margin, what do I do? Thank you very much for ameniambia kitu mzuri sana. If this is A and this is B, to get profit markup, Or rather, to get profit margin, you'll simply take here A over A plus B, like that. A plus B. Thank you so much. Thank you so much. So in this case here, margin, hapa base yake ni kubwa. Margin, base yake ni kubwa. So in this case, ladies and gentlemen, A is in 20, the back 20 over A, which is 20 plus B, which is 100, which gives me 20 over 100 and what here? 20, which gives me 1 over 6 if you wish. You don't have to cancel, but if you wish, cancel, which gives me 1 over 6. Aya, nisikizeni hapa kidogo, sijui kama hapa ni sawa, naweza vuta sasa hii, naweza vuta hii sasa. I wish you would take this somewhere there as a note. Very important note. Very important note. Very important note. Because what will happen, ladies and gentlemen, is this. You will get a situation where, you know, we are saying here that our UPS, or rather, our UPS, yes, our UPS is profit margin, not profit markup times risk. But now you go to a question where you get somebody tells you that profit, instead of giving you profit margin, he gives you profit markup. He tells you profit markup is 1 over 7. Is 1 over 7. So you know if it's 1 over 7, then at the end of the day, you will have to come here and give us profit margin. Iko mwingine kwa kiniambia tunajua mwalimu ati profit margin ati iko na makalio kubwa. Makalio, yani hii ndio denominator hii. So unaongeza ukisikia margin from markup unaongeza hii. Kwa hivyo sasa itakuja ikuwe 1 over 7 plus 1. To get margin, you always increase the denominator with the numerator like that, which then gives us 1 over what here? 1 over 8. 1 over 8. So if, for example, they gave us another small exercise here, they told us that markup, is 2 over 9. 2 over 9. 2 over 9. Can somebody go ahead and give me the margin? If they gave me markup as 2 over 9, so margin will be 2 over 11, yes. It can't be 2 over 10. Because you see, it's A, B. Here down here, we have A plus B. So this A. So I don't know whether it's everybody who is able to see what Mike is giving me. It's only Mike was responded. So margin, are they able to see this? Because you see, this is A, this is A, and this is B. And our formula for margin, itakuwa ni A over A plus B like that. So itakuwa A tabaki vile 2 over this A plus now this B of 9 like that, which gives me 2 over what here? 2 over 11, which gives me 2 over 11. Please don't get confused with this. This is very popular in your exams. This is very popular in your exams. And then Deborah is asking, why did you divide up there this intangible asset value with 5? You know, amortization is the same as depreciation. Only that now amortization is for intangible assets, and then depreciation is for these other ones that are tangible, the ones that you can tax, as you're going to see. So, and how do we get this amortization? Just like depreciation, straight line. You take cost over useful life. So 5 is the useful life there, Deborah. Maybe you could sum up. Economic useful life of the intangible asset in note number 2 is 5 years. And then once you get now depreciation per annum, don't forget to prorate, because that will be 200 over 5 is 40 for a whole year. And yet we stayed with this asset for only 6 months. So we must prorate. So Deborah, go and look at that deeply. Go and look at that deeply, like that. All right. Ladies and gentlemen, from there, we should be able to move with speed and go straight away to the next item. The next item is called trade receivables. Trade receivables here. Trade receivables. So for trade receivables, what do we have here for trade receivables? Yeah, great. So for trade receivables, we are told trade receivables were carried in the consolidated statement of financial position at 480. Carrying amount is 480. Carrying amount is 480. Carrying amount is 480. Carrying amount is 480. It's 480. This was after an allowance for doubtful debts of 60 million. Examiner will not examiner, but carry will not allow that. Not unless they are specific doubtful debts. So this gentleman had charged. This gentleman had charged 60 doubtful debt. Add back. So 480 plus 60. Add back. So the trade receivables were carrying the consolidated statement of financial position at 480. This was after an allowance for doubtful debts of 60 and an unrealized foreign exchange gain of 80. The allowance for doubtful debts and the foreign exchange gains, losses, are only allowed for tax purposes when realized. So of course they weren't realized. When this gentleman made, this accountant, when he foresaw a gain of 80, of course he must have included it here. And now that this gain is unrealized, you will come and tell the taxman, no, I can't pay tax on what has not been realized. All right. So in this case here, minus what here? You know, when it's a gain, he must have added. So to undo that addition, we subtract. Like when he made a loss, to arrive at this, when he made this doubtful allowance loss, he subtracted. But in this case here, because again it's unrealized, what do? We add back. But gains here, they're added. So gains we subtract. So somebody is giving me 460 here. Somebody is giving me 460. Somebody is giving me 460. So for 80 minus 460, this gives us a temporary difference of 20. Temporary difference of 20. Temporary difference of 20. So this trade receivables. Trade receivables. So kindly repeat on the foreign exchange gain. You know, like any accountant, when you have a gain, what do? When you asset gains, you add. But now after adding, you come and realize that, this is unrealized. It is still outstanding there. You haven't, for example, sold your currency. So you haven't realized it. Will you pay tax on it? No. So what do we do with this unrealized exchange gain? From the taxman's perspective, that has to be subtracted. That has to be subtracted. I hope, Richard, that makes sense. You see, like when you have in this case here carrying amount, when you charge a loss on carrying amount, it means you had subtracted. So to make good, what do? You add back the loss. If in this case here you had a gain in this carrying amount, so a gain means that the carrying amount went up, and you told that this gain is unrealized. So how do you make good? You subtract. You subtract. So if you just always know that losses, when I'm making a good correcting, losses I'll always add. Exchange gains or whichever gain, if it's unrealized, I shall always subtract. I shall always subtract. Great. Now we go there. Now we are told here that the balance of the deferred tax liability, so that can come here, income tax. We are through. We are through. So come and add here. Come and add here the total temporary difference. So the total temporary difference. Total temporary difference. What do we have here? Total temporary difference. Great. Total temporary difference. Total temporary difference gives us what figure? Somebody here. 350. Total temporary difference will always give birth to what we call deferred tax. So come here and give us the deferred tax. Come here and give us the deferred tax. 30% times 350. As what figure? 30% times 350, which will end up giving us what figure? It's 105, isn't it? It's 105. And remember, this is a liability. Because I told you, whenever the temporary difference is positive, that's like a profit. So you'll have to share this with the taxman. But now in the future, you'll have to share this with the taxman in the future. So these are deferred tax liability. Deferred tax liability. If it was negative, I would have called it a deferred tax what year? Asset. Now, ladies and gentlemen, from there come here and do Roman 2. Roman 2, they want us to do the account. If you look at Roman 2 of this question, they want us to do a deferred tax account, a DTA, deferred tax account. That's how we call this. So we have what has been brought down there, balance brought down. This is given in note number 6, note number 5 actually. The balance on the deferred tax liability account at the beginning of the year was 25 million. So balance brought down is 25. And what we are deferring into the future, the deferred tax is this 105. So into the future, the balance carried down. The balance carried down is this 105. This is what is deferred to the future. Will not be paid in this year. Deferred 105. So you ask yourself, remember we have a revaluation amount in this. So this revaluation amount, the revaluation amount, ladies and gentlemen, leads to what we call permanent differences. Because the revaluation amount here, the taxman will never allow. Remember we said permanent differences are those differences which arise on transactions that are disallowed by the taxman. The taxman will never allow them. And if we never allow them, then they will never feature in our tier, in our temporary differences. They should never feature there. But now here we have it. And because we have it, then this amount here is overstated. Is overstated. This only happens whenever you have revaluations. So this amount here is overstated. So what I need to do is to come here and bring in the revaluation tax. You guys had given me this revaluation amount. It was 200, but I want the tax of it, the tax of that, which is 30%, revaluation tax. Revaluation tax, so 30% of this 200, which will end up giving me what figure? Somebody here? 60, not 6, 60. So go ahead and balance this thing. 105 is bigger, 105 is bigger, 105 is bigger. So the balance is what we'll pay to our income as our income tax expense. Deferred tax and income tax expense, then of course we'll combine it with the annual normal tax expense for you to get the consolidated tax. So the P&L will be 105 minus 60 minus 25. Great. 200, 200, 200, 200, 200. So of course, in this case, ladies and gentlemen, if this a good student is asking, what would have happened if this was, for example, like a negative here? All right. Then our balance carried down would have come on, if it's an asset, remember assets, what do we do with assets? Balance brought down normally comes here. Balance carried down goes here. So then if it was to be an asset, we do it the opposite. So balance carried down would have been here. Balance carried down would have been on this side. Quite funny, but it happens. You'll also be able to get these kind of things in your exams, where balance carried down is coming. You have a liability, but at the end of the day here, you have, in this case here, an asset. So you simply balance your accounts even if it's coming there and get your stuff like that. Repeat, is not 200, but 20. Mikali, where did you get 20? The P and the L is 20. 200. How could I get, in this case here, 200 and this is 105? Great. Thank you so much, Mikali. Great. Should be 20. Should be 20. If there is a ninja who was sleeping like myself, please change. There could be a ninja who was sleeping like myself. So this P and L is the income tax, the annual income tax, the annual income tax, the annual income tax, annual income tax.
So, ladies and gentlemen, that marks now the end of this question. It's my pleasure that you guys have been able to enjoy and you've learned something over lunch hour. So as RCM students, of course, we shall be having this as a bonus, especially for AFR. We shall be doing this over lunch hour. Every lunch hour, we shall be having some little concepts that we should be able to learn out of my low-hanging fruits, those areas that Mwalimu thinks, that Mwalimu in this case here knows will have to be in your exams. We shall be watching questions from those areas often. Like now from next week, I'll be going to group consolidation. Group consolidation must be in your exam. We shall be doing group cash flow. The moment I understand group consolidation and group cash flow, automatically I have over 35% of that paper. And then you come to these short topics like share-based, like deferred. We have reconstruction, both internal and external. And then you shall not, in this case here, go wrong. So please, I know it's not easy to sacrifice your lunchtime, but trust you me, it will be worth it. You may not be able to see the difference right now, but cumulatively, by the time we are doing like 4 weeks, you guys will be very far away ahead in terms of what year this AFR is concerned. And of course, I would want to take this opportunity to welcome anybody who is out there who has not yet made a decision to join RCM College, online college. This is the place to be. Join us. Our number is 0719 525 000. 0719 525 000. Otherwise, I wish you all the best as you go back to your workplaces. Yeah, great. We are doing this deferred tax terracia. You're not late. You can join us. And then remember, we have a learning management system. Lucy is bringing up balance brought down. So Lucy, because of time, I'll not be able to address that, but of course, balance brought down will be given in the question. So long as you've been able to pick the most important things, given that I also must go back to my workstation now. Thank you so much. Be blessed. Be blessed. Oh, we do every topic. Okay, fine. I will be able to help you, Caro. Don't worry. Don't worry. I'll be able to help you. Thank you so much. Then see you guys. And of course, Joshua Aura on YouTube. You need to support your Mwalimu on YouTube. Get there and ensure that you are subscribing. There is somebody who wants to see my face today. No. Today is a day for watching videos. Thank you. Now we've come to the end and I shut down the systems. Bye. See you later.